Years ago, I read a white paper titled, "Your Brain is Your Greatest Enemy." And so I had to ask the question, what does that mean? Why is my brain my greatest enemy when it comes to investment decisions? It's because the market is a discounting mechanism. It is a leading indicator. It really has an unbelievable way of seeing the future and discounting future events. So if you have a bias, which is, from watching television or listening to the media, so forth, you're going to have to deal with that because things happen such as recency bias, which is where you only can, think about things that are recently going on, whereas the market's thinking about something completely different. You should always let the market lead you. Now, one of the other biases we have is something called anchoring or the anchor trap, which is where you hear about something, you make a decision, and then no matter what, you won't change your mind about that decision. Well, that can really be disastrous. So, think about it. If you believe there's inflation coming, or you believe that there's an economic recession coming, but the data doesn't confirm it, well, you can see where that would be a problem. So let's get into the market. This is what's going on. NASDAQ new high, acting really well. We saw a couple of weeks ago where we started to see a break above that 10-day moving average in an uptrend. Looks very positive. Now the mid cap's a little different. We're seeing a somewhat of a breakdown there. However, it does look like somewhat of a recovery here, but it's not positive. Here is the New York Composite, same thing. These are all the stocks on the New York Stock Exchange. Pullback, held the 50-day basically, trying to get going again. Small caps, same story. So you can see where the NASDAQ is really leading the market right now. So the small caps continue to struggle. Now the S&P 500 new high, again, came down, held the 50-day, broke back above the 10-day. So the large cap NASDAQ and the large cap S&P 500 stocks are outperforming the market. And the general rule is when the generals lead, the troops will follow. Now, I made a little bit of a change on this particular indicator just so we can see it more clearly. We're going to talk a little bit about this. The rule on this particular indicator, this is the 35-week moving average. Now you can see that the NASDAQ is staying very nicely above that moving average. This is what you want to basically avoid. This was the pandemic back here. The basic rule is week 1, week 2, start getting very defensive, and at the same time you do the same thing with the S&P 500, which they tend to confirm each other. So again, we can see that right now we are in a very constructive pattern. This continues to be a bull market. Now on the aggression index, seeing much improvement there. We're getting a reading right now of about 206, 207. We got down to readings as low as 190. Held the 40-week moving average, is now turned up. So the good news here is you've got a low, higher low, now you're making a higher high. So that's very positive. The market's becoming more aggressive. Technology stocks are starting to lead again. Russell 2000, this is the growth portion of the Russell 2000. It's the Russell 2000 Growth ETF. You can see that since February the 10th, it's been in pretty much a downtrend. However, looks like we may have made a low here. Higher low, higher high, higher low, trying to make a higher high. So we're starting to see much improvement in the growth stocks. Our three economic indicators, interest rates continue to stay low, 1.489 on the 10-year Treasury. Again, if we're worried about inflation, the market would tell us with higher interest rates, in my opinion. Now, the price of oil continues to stay in a very good uptrend, above 70, actually got up to $75 a barrel the other day. The financial stocks have turned down along with interest rates, however, possibly have made a low here, but somewhat of a downtrend. New lows, we're not getting over 40 a day, so we're in good shape there. Now, on the yield curve, again, I want to emphasize this is a leading indicator. You get an inversion of the yield curve, which is where the 3-month Treasury yield becomes higher than the 10-year U.S. Treasury yield, and so you get what you call an inversion. Well, you get the inversion in 07, then you get the recession in 09, 08, 09. Here's the inversion of the yield curve back with the pandemic, And there we got the drop off and the recession that followed shortly thereafter. But the only thing I can say now is that the yield curve is starting to flatten out a little bit. We're no longer seeing an uptrend in the yield curve, but it's not troubling. On sentiment, we're starting to move back into neutral on sentiment on the AAII bull-bear ratio, which is good. We want that. We don't want a lot of optimism. We want to see a little bit of fear out there. So as you can see here on the put-call ratio, we continue to stay in greed. This has been an ongoing problem for a while, but it'll stay there for a while, and we just want to be aware of the fact that there is just a lot of greed in the market right now. Now, here is another indicator that I've been using called the inflation-protected Treasury bond compared to the regular Treasury bond. Now, you can see when the market's concerned about inflation, which the TIP bonds are bonds that you would buy if you're concerned about inflation, and you can see that this has been a pretty strong uptrend really ever since the pandemic. And so as you can see here now, this is starting to come down, make a little bit of a downtrend here. So it's basically saying that really the market is not discounting inflation, and the Federal Reserve has come out and said this is a transitory period. This is not going to be a long-term problem, and we're certainly not going to see something like the 1970s. Now on junk bonds, here we have the high-yield junk bond compared to the 20-year Treasury bond. Again, this is a ratio. You can see that it's been in a very nice up pattern, however, has somewhat rolled over, so it's a little troubling. We want to keep an eye on this because, if there's no inflation, does that mean deflation? Well, this is kind of a deflationary move here because when people are real optimistic about the economy, they're buying junk bonds over the Treasury, but that has changed. Volatility index continues to be okay. We did get somewhat of a spike here, and then we got another little spike here, but it's really dropping down. I mean, we're down to 16.3, which is one of the lowest readings we had. So this is positive for risk assets. Now, on the top 5, we continue to see the oil story unfold. In fact, we got pretty much shaken out of oil stocks, but took a new position recently. But you can see here with Continental Resources, which is an exploration company, break out to an all-time new high. Very positive. Here's Callon Petroleum. Now, this is the one that we bought. Reason we bought it was we got what we call a volume signature down here, which means that the volume is favorable. I mean, there's buyers coming into this. Broke out, made an all-time new high. Crocs. Now, this is kind of a crazy one. This is rubber shoes. But it's been on the list for a while. We got a gap up way back here, flag formation, which has continued to unfold into an uptrend. So Crocs looks positive. Here's Devon Energy, another energy stock as well. We did own this one. We got shooken out of it here. We made some good money in the stock though, because we kind of treat these value stocks, which energy and things like energy and banks and all that we consider as value stocks. We tend to trade those a little bit more, whereas with growth stocks we tend to buy and hold as much as possible. But you can see here, came down, made a low, and is now bounced up. Here's Marathon Oil, same story, gap up, a flag formation, it broke down, but as of today we're starting to see a rally here. So that's basically it. If you have any questions, please let me know. Thank you.